chip trick. I don't mean cheap trick at Budokan. I mean Nvidia. Why is it not up more this morning? Selling chips to China. We'll dig into that. Not much earnings. Toll Brothers in the red, getting towards that expected move. We'll talk about some trades in the after hours and the pre-market. We got a special guest today at 8:35. That's Todd Gordon. Actually, he's going to come on a little bit earlier. He's got some charts. He's got some fundamentals to discuss with us. Folks, it's a busy day with another new co-host working it in today. So we will bring him on in just 1 second. Let's figure it out on pre-market prep and get ready for the trading day on Stock Trader Network.
The volatility right now is really incredible.
Wow, look at that consolidation on the upper right chart.
You know what we've seen this earnings season? Some of these expected moves get even more violent. And this is why I have switched my strategy 10 years ago. And if you're chasing, you're in trouble.
All right, good morning, traders and investors. We're barely up a handle and a half, just above the close, 57.25. After that slight down day yesterday, the buck flat, buck futures flat, 99. TLT sinking again yesterday, but up 14 cents today at 88.02. USO hanging out at 70, down 20 cents at 70.29. GLD and SLV both in the green. GLD up 1.37 at 386.79. SLV in the green by 66 cents at 53.37. And Bitcoin getting farther and farther away from that double top. Down $100 in the futures at 90,890. All right, so we had Jim Tassoni as our special co-host yesterday, and today stepping into the hot seat, Chris Brecher Trading Nest TV. Chris, are you ready for the big stage?
Yep, I'm here.
And y'all know why I like Chris, right? And he's a favorite because of what's in the background there. Chris, tell our audience what's in the background there.
Well, it's hard for me to show it this way, but that's me on the CBOE pit and the IBM pit for 8 years. I stood in the same spot. So, so I was a floor trader on the CBOE for 8 years in the IBM pit, and then I was, so that's what I did. I mean, that's why I'm really into options, and I was really into charting when a lot of other people weren't. So that's where a lot of times the market maker move into earnings, I understand, but a lot of times with chart objectives, it's a lot different than the market maker move because a lot of market makers just go on the public paper. They don't really go on the charts.
Well, first of all, how early did you have to get there to get the same spot?
Well, it's interesting. I always came in early, but if I didn't for some reason, I just pushed them out. I mean, it's a pretty physical kind of thing. But people sort of, well, another thing, yeah, I shouldn't really tell you this, but I would go and like eat onions and I would do just awful stuff. So if I went and stood there, people would move.
Yeah, that's
So,
interesting.
but usually it's you get a pecking order after a while that people leave that spot alone if you're there long enough.
And the other question, so did you chart? You had to chart by hand back then, right?
Yeah, there was one research. There was a little room above the CBOE that had those SRC chart books. Remember those? And the blue cover, those stock charts. I don't remember what it was called. I think they still have them, but that you'd go up there and you'd read the charts, but they, they're from Sunday night. So I actually would get Federal Express charts Sunday night. So I'd have a book of charts, but they had one computer up there that had charts. So like every time at noon, I'd go up and look at the charts. But like at IBM, you sort of get a feel of if it's what kind of pattern it is. But there were people that paid other people to just plot every high on graph paper.
That's what I was referring to. Okay.
Yeah, it's pretty wild. And then Helene Meisler with Real Money Pro still does that. Did you know that?
Yes, I know it. Yes, she's been a guest on the show. Yep, I'll have to dial her up. So let's get to the big news. The big news after hours yesterday. Trump's decision to allow Nvidia to sell advanced chips to China marks more than just a shift of U.S. tech policy. It also raises questions about how far he'll go to steady ties with Xi. A couple different things here. They're not the super extra powerful chips, number one. Number two, the government's getting a little cut of that, so that's not bad for the government. Let's talk about the price action and what you observed.
Well, it's interesting. You and I were talking about it that you can short Nvidia up to 8 p.m., but you can't put in stop orders till the EXTO session after hours, after 8 p.m. So if you don't want to be there, you can't put in a stop. So if you short it, let's say 7:30 at night, you can put in a stop at 8:15 p.m. And a lot of people say, well, stops, it's a liquid. These stocks are really liquid with like 4 cent wide markets all night. So you can put in a stop order, but like me, I looked at Nvidia and I tried to short it at 190. And then I'm like, I'm not going to stay till 8 p.m. to put in stop orders. So I just canceled my order and walked away. But if you look at a chart and believe it or not, these active ones, you can chart all night. And Nvidia, once it broke 190 at about 610 last night, that was it. It's never been the same. So on what you were saying with Nvidia, with that the chips they're able to give her, they're lower quality. That's one reason I think the stock sold off, because they're saying that Chinese companies aren't really interested in that chip. So you can back it up with a chart. I always like to back it up with a chart. So when you saw the momentum fail, that's when you could initiate a short. And then if I was able to put in a stop, you just put it versus the high. That's what I would have done.
Yeah, and you just picked that nice round number, 190, 190.01. Yeah, it sold off, and we'll see what the price action happens today. But yeah, it's not like they even want them, right? I think that they want, they're really trying to establish better relations with their own companies here. So I mean, it's good news. It's trading up $1.61, but way off the pre-market high. Pre-market high comes in at 190.99. We'll see if it goes flat on today. That closing price for Nvidia, 185.55. What about let's talk a little bit about options here in option skew, and you had some interesting things that you wanted to point out here, I believe, with Aklo. So I'm going to remove mine. I have this chart up. Is this the one?
Yeah, and I actually had first for you Nvidia on the right, so you could see that little head and shoulders in the break.
Okay.
So there was that. But yeah, the what I wanted to show you here in like OKLO is so many, like know how to buy calls or are scared to buy puts. And a lot of people talk about stocks go down faster than they go up. I mean, some of these short squeeze ones obviously go up pretty fast too. But there are over 400 to 500 active stocks that are down for the year. So there's a lot of money to be made on the downside. Let's say 20 years ago, though, the puts compensated for the volatility on the way down versus up by the skew being positive, where the puts were a lot more expensive than the calls. These days, as you see with OKLO on the left, and I can put it on the right as well and take off the non 24-hour, I mean, it goes down just as fast as it goes up. And what's wild about that is the put premium is basically the same price as call premium. So you could, if you're inclined to just buy premium in the direction of a move, they're not respecting how fast stocks can go down.
There you go. That's what I wanted to see there.
Yeah, you see the 104 puts for next week and the 104 calls. I know it looks like you could drive a truck through the markets, but if I just take the midpoint, so the stock's 104.61, and you take the 104 puts are like 7, and the 105 calls are like 7.5. So the one's like splitting the difference. So it's not like the 104, and you could take the way out of the money as well. So let's say the 4 point out of the money, 4.5, the 100s are 550, and the 5 point out of the money on the calls is 550. So there isn't that skew that you're used to. And also the vol's so low anyway in the overall market that it just goes to show you can make just as much money on the put side as the call side, is the point. That, I mean, I'm telling you, after 1987, you saw things where the skew was gigantic. And so even if it went down, it was hard to make money because then they destroyed the time premium.
Okay. All right. Interesting there. A little bit of an options. I'm going to pull you down. I'm going to put my charts back up here. And we had one earnings report that I want to cover here. So give me 1 second. We had Toll Brothers. Just real quick, these charts are brought to you by TradeStation. Chart analyze, customize, all in one platform. TradeStation, born to trade. So let's get the only really significant earnings last night. That's coming out of Toll Brothers, and Toll Brothers Street is not liking the mixed report. They missed on EPS, 458 versus 489. Slight beat on sales, 3.42 versus 3.30. Soft demand in the housing market. That's not a good sign. The stock was selling off into the report. I have expected move right around $9. So we're getting awful close to that. Really didn't get much of a pop. Now trading in the red. Losing the 50-day here, the 200-day way down at 120.40. I only see one daily low to take a look at. That's 127.26. That follows with just outside the expected move. Chris, any comments on Toll Brothers?
Yeah, this whole thing, it's funny on how one thing relates to another. So the CRB going up is bad for long-term bonds because long-term bonds don't like inflation. And we can go in the thing about appointing the Fed on if it's somebody amenable to, let's say, more strong arming in certain ways, that the independence of the Fed, and maybe that's why the long-term bond is going down. But the reason I'm mentioning that is if you see the chart side by side, you'll see the rally in the bond market in September corresponded to the rally in Toll Brothers. The sell-off in bonds this week from 118.04, the ZB, to 115.04, it's corresponded with Toll Brothers rolling back over. So it's interesting that the yield curve steepening, which is bad for mortgage rates, is Toll Brothers is incredibly sensitive to it and reacting the same.
Yeah, I think this is indicative of we got the Fed meeting tomorrow. The CME Fed funds tool way up there, guaranteeing that quarter percentage, but they're looking a hawkish tone, perhaps. Maybe taking the next two meetings off and see where the inflation numbers come in. Now, a little bit different here. The inflation numbers are going to be next week. So does the Fed have that data? Of course, we don't have a lot of the employment data, right? Because of I think I just saw that they postponed the next jobs report until January or something. So the Fed is flying on a little bit less data. Let's take a broader look here at the XHB. That's holding up a little bit better. I guess you could drill down on the components, but TOL dragging that down today. KB Homes, take a look at that chart. That's been holding up a little bit better, but falling with the in sympathy here with Toll Brothers. Any other comments on the housing sector?
Yeah, well, I think what you were saying about the lack of government reports, I think the Fed, well, I don't know, but I think the Fed is going to look more at like external data like the Commodity Research Bureau, the CRB, because that's indicative, even though that's not services. So it definitely doesn't have like services in there. It's still indicative of what consumers are paying for commodities. And that's near a new high. So I think that is going to, I think they're going to be more sensitive to moves in the CRB than maybe they were before because of the lack of data they have to their disposal.
Okay. All right. So our special guest has arrived for a little bit of an extended session here. So with no further ado, let me bring in our special guest. All right. Joining us early. You guys know him. He's Todd Gordon. He's the founder of Inside Edge Capital, 13-year pre-market prep contributor, wealth management, active portfolio management, financial planning, former hedge fund trader. How is that for an introduction?
Wow, Joel, that's a lot. Thanks, guys. Appreciate it. Good morning. How's it going?
Good. I have another floor trader with me.
Oh, yeah?
Brecher. Yeah. Filling in for Triple D. I told you yesterday, Triple D and Brent, man, they hit the road on me. But before we get to your topics and stuff you want to show us today, Chris has a couple curveballs to throw you.
Sure. Hey, Chris, how's it going?
Hey, fine. Is nice to see you.
You as well. Where did you used to trade?
On the CBOE for a long time.
Oh, right on. Very nice.
So
as I explode a Celsius on my desk, that's a great way to start the trading day.
In fact, behind me, I was in the IBM pit for 8 years. I'm the one in the orange jacket. Dr. J was in that pit. That's when he had hair.
Oh, I know John quite well. I've gone skiing with him a few times. That's awesome.
So yeah, it's we were in the pit all 8 years together. I mean, he was there as long as I was there. In fact, he was there a lot longer. But I had a couple of questions for you. So I've watched a lot of your interviews, and I promised I didn't fall asleep in any of them. I found them very engaging. And
thank you.
And I followed you on social media, and really respect your opinions on all these things. And I saw where you were talking about in November, you were short-term cautious, still 3 to 6 months out, very bullish.
Oh, wow.
Is that still your thesis? And what would make you change your thesis?
Well, great question. Well, wow, thanks. Appreciate that so much. 3 to 6 months cautious. I think in the most recent, I think with a little clarity with the Fed that will be released tomorrow. I think once the market gets through the idea that we're going to reside at 3.5 to 3.75 Fed funds for the foreseeable future, number one, number two, the economy can handle it. I think that's when we can potentially go back to focusing on earnings, which in Q3, I think have been tremendous. So maybe back to, I have some slides prepped for you guys. So maybe we can just continue on with this slight acknowledgement that the value trade collectively is starting to back off here as volatility has been elevated. The growth trade's starting to come back on again with Fed clarity. Like, it's not like the market sells off and everyone's going to ditch equities because the Fed's going to stay at 3.5 to 3.75. So let's get the macro out of the way a little bit, go back to focus on earnings. I still am very bullish on the AF build out, and maybe that's going to shift us to near term, bit more constructive in 3 to 6 months out. I would say very constructive. I think it's been a bumpy year. in 25. We have pretty good returns with 3 weeks to go year to date, but it's been bumpy. We had 2 significant sell-offs this year. It hasn't been easy. I'd like to say we may have smoother sailing going forward, but who knows? You don't get hit by the train you see coming.
Yeah, and the other question I have is a lot of the rally. I mean, earnings have been fine. I mean,
Yep.
companies have been able to absorb the tariffs fine for now. But another thing that was a source of the markets going up was the gigantic amount of buybacks from April to October,
Yep.
like over $1 trillion worth. And a lot of that is CEOs being confident in the outlook. Do you think that what would make CEOs less confident? Would it be a spike in yields? Would it be
Well,
more trouble in China? What do you think?
that's interesting. And again, I have a few macro slides.
Let's go to them, Todd. Let's
No,
go
it's
to 'em.
fine. Prep, it's really good. I'll bring them up. I mean, obviously, turmoil in the executive branch is going to be a major factor. We'll see what happens with tariffs. I think some of the dust is starting to settle. I don't know, what would shake CEO confidence in the new year? I'm going to go back to it. You don't get hit by that train around the corner that you don't see. I think things kind of smooth out, but that move, you mentioned in rates. Have you noticed, though, the Fed is potentially on hold, how that 10-year yield is kind of poking above, and that's creating a little bit of uncertainty?
Yeah, I'm watching the commodity of the CRB because me and Joel were talking about it. With
Okay.
the lack of some of the government reports coming out, I'm wondering how sensitive the Fed is to watching the commodity index.
So yeah, the CRB, I haven't really checked up on it. I mean, I'm watching crude just kind of hang right around that 60 mark. Gold looks bid. The dollar is mostly under resistance. And again, I can show you some charts here. Joel, do you want me to jump in or?
Yeah, jump in there. I'll bring them up.
Okay. Let me see entire screen. I even made a little presentation for you.
I know. I just Chris had those good questions.
It's great questions.
Yeah, and leading right into it. All right, here we go.
I was even gonna throw like a nice picture of you up, but I just ran out of time. I had to go kiss my daughter goodbye for school. I'll flip through here a little bit. I was gonna look at some long-term stuff, the technicals, growth value. Let me flip over to the macro because we're on that conversation. Internals, December cut. All right. So, there's been a lot of volatility in the Fed fund futures. And, maybe I'll throw a question back at you, Chris. Like, do you know any of the Fed fund futures traders, number one? And number two, they seem so off in terms of like the swings they see in the, in the front month, back couple months, Fed fund futures contracts compared to what the Fed actually does. Do any of those guys make money? Or like, I don't know any Fed fund futures traders, but I always wonder, like, it seems to be a very volatile, unpredictable pricing system, voting system ahead of the Fed. Any color on that?
No, I seem like trading from home. It's not like I have the red phone to Powell, but no. All kidding aside, I don't really know any Fed funds futures traders. I knew some bond traders, and I know that we've been gaming the CPI and the PPI by watching the commodity indexes
Okay.
from the prior month. So because the CPI and PPI are a month look back,
Sure.
and that's worked pretty well. But I don't know any Fed funds people.
I've had a hard time keeping up with the CRB because it seems like the admin, the owner has changed hands several times. They're always changing the symbol in the 20 years I've been following this. Like, I don't know. It's been hard to follow it. There's been like 3 changes of like the owner of the CRB, hasn't there?
Yeah, I've been watching more on Thinkorswim that's DJCI.
Oh, okay.
So
right.
that's worked pretty well because that also includes the oil, and that's near a multi-year high, even with crude oil doing nothing.
I had toss up. I gotta try that. You said what's the symbol?
$sign DJCI.
CI. Okay. Oh, here it is right here. All right. So I'll just throw that over the top. So Okay, yeah, wow. All right, it certainly bid. There's got to be a little, not so much energy in this, is there?
Well, it's amazing that it's gone up this much without energy.
Right, right,
So, I
right.
mean, there's the ETFs, the DBA and the DBC,
I know
and
those Deutsche Bank ETFs. Yeah.
I like watching the DJCI more, and I wonder if the Fed's watching something like this because aren't a lot of other data to lean on.
Interesting. Interesting. I'm going to consider it. I appreciate that. So let me see if I can tie that in for you if it makes any sense. So the original question, like watching the volatility in the chance of the December rate cut it was massive. Right now it's 89%. I remember the last 2 weeks it was down to like 30%, it was 50%. And now we're setting into 89% chance of a cut going current rate 375 to 4. We're going to go down to 35, 375. And this is like the aggregated probabilities in coming markets. So 89% chance of going 3.5, 3.75. And the next two meetings after tomorrow, best odds are unch. And then 2/3 chance as of now in April of 26, when the spring's coming. And Joel's going to get ready for his first real trip to Saratoga somewhere around the July meeting, maybe, Joel. But, so why is the Fed, so with the Fed done, why are we getting this push up in the US 10-year yields? It's gone pretty big. And it's the one thing from a technical point of view, Chris, you were asking, like, what could really derail, increased volatility, could, bring a lot of uncertainty into next year. I'm looking at this just, consolidation triangle pattern, US 10-year yields. This base is back in, that's going to be in 2023 right here. That's the turn of 23. That's mostly 2024. Here's 25. The US 10-year yield and, across the whole curve have been pretty tight. And we are bouncing off technical support on the weekly. Daily, you'll recognize that pattern. I mean, it's almost, that guy's misplaced. It should be here. It's almost a little reversal head and shoulders pattern. And why are we breaking here? How much higher will US 10-year yields go? And why are yields going higher? That's one question I have. Normally, I mean, I'm an old FX trader as well. So, I got first seat view or firsthand view of macro correlations during the GFC. I was an FX trader. So watching how fixed income, equities, commodities, currencies all play together, which, primarily we're equity traders, but you got to know when those other major asset classes are impacting equities, and it's going to give you a good heads up. So normally I'd expect to see, with that US yield moving higher, interest rate differentials will drive foreign international flows into the US. You got to sell international currency to buy dollar, to buy our higher yielding products as those yields go up, or maybe they're going into our equity markets. So normally you'd see that US dollar following the US 10-year yield as, again, our rate differential increases relative to the rest of the world, and the dollar's backing away. So that's good. If we saw rates bid, the dollar bid, that would be problematic for me. But the dollar is kind of backing away. And not to get too much into the weeds, but this whole yen carry trade thing, with yen being so weak, a lot of people, especially in the US, are kind of macro ignorant, don't really know what to make of it. I think it's more a good thing as the yen carry trade is going on. International money managers, macro guys, are borrowing in yen cheaply, investing in different international economies at higher yields to make that interest rate differential. They wouldn't do that unless they saw that volatility was going to be compressing in coming, months and year or two. So that's a whole different conversation. But it's good that the dollar is backing away from resistance again as that US 10-year yield is breaking out. I don't want it to go too much higher. Can we settle into the 200-day moving average here at like 4.25 or so? That'd be fine. And I think equities can continue to power ahead if that happens. Gold is weird. And I'm sorry to go on a roll here, boys. I hope it's okay.
No, we're following you, putting everything together.
Okay. I like gold going higher. And again, I think this is what a lot of people don't. As an equity bull, I'm still very bullish on this market. I think a lot of people don't understand from the macro point of view, you want gold to push higher. The combination of US yields, which I don't want to see that 10-year yield get too much bid, but the dollar under control, without, a ton of US dollar strength, which generally hurts equities, that's going to allow the gold market to move higher. So yields under control, dollar under control are both good things for both gold and the stock market, which means there's a fairly loose direct correlation between gold and S&Ps right now. So I want to see gold push higher. I didn't include GDX in here, but gold miners are like up in the highs. So in our portfolios at Inside Edge, both in our flagship growth and our income portfolio, we did increase our exposure to miners, gold miners. And again, it's kind of crazy to think, but I think it's a pro equity, confirming indicator. I'll finish up real quick on the macro conversation. Bitcoin liquidity with the Fed potentially no longer cutting rates is a problem. This whole MicroStrategy Bitcoin correlation is interesting. This is a big time Monday morning quarterback. But if you look at Strategy, the artist formerly known as MicroStrategy, look at the divergence. This is like 2024, the end of 2024, a year ago. MicroStrategy makes a high, makes a significant lower high, and then gets crushed. Bitcoin didn't quite acknowledge the lower high that Strategy put in. Bitcoin put in a higher high and then got smoked. So MicroStrategy potentially was being a leading indicator of Bitcoin. Tom Lee, who I really respect and I'm buddies with him, he was saying most of the big guys are hedging out Bitcoin exposure in MSTR, which just have very liquid options. So MicroStrategy is giving Bitcoin a heads up. Tom Lee came out a couple of weeks ago and he's like, don't make any mistake that Bitcoin is very much a leading indicator where the NASDAQ is and stocks in general. So Strategy was giving Bitcoin a heads up. Bitcoin was giving a NASDAQ and S&Ps a heads up. And we have, I think, shook off the weakness as Bitcoin is stabilized around the 90 to 92K. So that whole cycle that, been setting up for a year, I think potentially is done. I hope Bitcoin does not get cracked for the same reason I want gold to stay bid. I want Bitcoin bid, gold bid, and that from a macro point of view would allow, I think, equities to continue to go. But I'm not a Bitcoin like table pounding bull. I have a small exposure to it. So I just want to start off with the macro, guys, if that's okay.
No, that's excellent. So that's the last slide of your slides there.
No, I got a few more. You can go in a bunch of different directions if you want. We have some sector allocations I threw in there for you. I threw some internals in there in the market. Chris being an options guy, maybe we could do some vol skew and maybe we can talk to that a little bit if it's helpful. Wherever you want to go.
Let's go to the volatility.
Okay.
And the vol skew and also growth versus value trade.
Okay. So I with the realization that the Fed may be done cutting, I was shocked how high the VIX was in November. It was like 28 VIX. And then you look at the implosion in the VIX, we're back down to 15, which I think the new regime in the VIX is, 12, 13, 14 is the low. But I actually see a little in like VIX divergence to the S&P because VIX made a slight new low as the S&P really hasn't made a new high. So I think that's a bullish indicator that volatility is coming in. The front month, around the at the money options are not, being so bid up for protection. So I think that's a bullish indicator that we might stabilize. And I do have some technicals, Joel, around the indexes if you want to look at. And then the vol skew is a really hard one to understand. I've studied it for years. Chris, I don't know if you could really solidify it for me, but as far as I understand, VIX is measuring the implied volatility of the at-the-money puts and calls in the S&P, and that tells you how much current volatility at the market there is, where skew will measure how much the put and call skew, the difference between each other in 1-2 standard deviation options. The higher the vol skew, which is in black, the less spread between puts and calls out of the money, the less that traders are paying for out of the money tail risk insurance. So basically they follow each other. S&P would basically follow the vol skew. As the market gets higher, people are paying less for that out of the money disaster insurance. The skew is not at new highs where the S&P is. So I'm wondering if there's too much out of the money put buying for disaster insurance because of all the geopolitical, domestic political, some of the macros that we looked at. I almost wonder if there's a little catch up to go in the vol skew as people unwind those tail risk out of the money hedges. And are people too wound up right now? And if they unwind those, do we do a little skew SPX catch up, or is that no longer applicable? This is a very, dark market, so to speak, and not a lot of people understand it. I don't know what you guys think here.
I think we're just from my perspective, looking at the volatility and looking at the S&P. I mean, we're just kind of stuck up here. Whether it's waiting on the Fed, you have seasonality coming in. I mean, of some stocks you got, the tax loss selling. I mean,
Yeah,
I think a lot of it. But a couple things. Can you go to the sector rotation? I know you have that fancy thing from Tom, who we had on the show.
Yeah.
Yeah, the lifeline of the market, they just very rarely have a sell everything market, right? Money's moving around. Tell us about the rotation you're seeing.
Yeah, this is just a fun little relative rotation chart. You're measuring each dot as 1 week, so you're looking at 8 weeks, and this is the S&P since 8 weeks ago, so whatever that is. And this is kind of a simple chart of the actual SPY, which you can see ever since we made a high, we've been just kind of messing around there over the last 8 weeks. So that will show you the rotation between the 11 sectors that make up the S&P. The big one has been healthcare. We're seeing obviously some pretty good rotation, not necessarily just in the name of defense, but there's some offensive components in sub-industry groups within healthcare, like biotech and some pharma that's been moving up. So healthcare has made a really big move in the time that the S&P has done essentially this little double top starting to roll over. Tech is heading in the wrong direction. Generally, you want to see things rotating from left to right in a clockwise fashion. That indicates relative strength compared to the benchmark, which is the S&P, and relative momentum. So tech is like, it's trying to move out of favor, but the fact that it resides over here to the right means it's still the strongest. And if we were to see a rotation back up in XLK, that's super bullish. Comms, has been rotating out, even with Google being so strong. Meta has been a problem. Netflix has been a problem. XLY is also been rotating out, but both of them are starting to hook up. So you got tech and comms hooking up from the basement. If we can see a rotation in tech and comms, I think we step on the gas. Industrials trying to move up, financials trying to move up, and utilities have also moved out of favor. So because we've made the move in, we're trying to head back. So the two main defensive sectors, I think utilities and healthcare, are pushing lower, where staples is trying to get into the race, but is so far, off the back that there's a long way to go. So tech here, comms and consumer discretionary rotating up with still some of the defensive guys rolling over. That makes me bullish. In a much simpler way, I think, to say this, and I'll jump into sectors here in a sec. Let me just pull this together if you don't mind, is this. So this is Vanguard Growth and Vanguard Value, the flagship growth value. And all I'm doing is taking VUG into SPY and making it a ratio. The squiggly line is the actual VUG SPY ratio. So since November, growth relative to the S&P has started to move up, where I would argue that value relative to the S&P had its moment here in October, November, as I just showed you, with healthcare, staples, and utilities, but is starting to head back down. So with the VIX moving lower, with growth starting to show some relative strength to the S&P, with SMH up at the highs, I kind of think, the December Santa Claus rally into the new year, I think we're starting off on a pretty good footing. And I'll jump back into sectors as you asked, Joel. I also see the on the breadth New York Stock Exchange, stocks above 200-day moving average. Like we're not overbought by a long ways. I mean, I would say we're almost like this kind of shape. I would say is like something over here where we're close to sort of the lows, or maybe over here where we had a nice little move up, and there still could be a long way to go until the amount of stocks in the NYSE above 200-day really starts to get above 60, 70, 75. That's overbought. So
a lot there.
Yeah. So I just, if you want to take a look, like these are the two flagship portfolios that we run, and we just did big reallocation readjustments. And the two big things that we're seeing is we have caught some of the offensive consumer discretionary right here in tag. I did increase some of the growth related names in utilities, not the defensive, but the power generation and AI. Over here, we increased consumer discretionary a little bit in SIG, which is our dividend. We also increased materials, utilities, real estate. Again, I think it's rates kind of under control. So we're getting a little bit more offensive as we head into Q1 of 26.
Good. Couple questions for you
Sure.
here. Is the IWM breakout for real? How many times?
Oh, what a good question.
That's coming from Money Mitch in the chat.
Hey, what's up, Mitch? I got to go over some baseball stuff with you, Mitch. How do I stop
Will
sharing?
we get fooled again?
I don't know. I was going to stop sharing. I don't know how to do it here.
I can take it. I can take it.
I'm watching that IWM, and the problem with the Russell, I gave you a long answer. Like, it's a doomed index to begin with, because anybody who starts to gain some real market capitalization and some real strength graduate out of IWM and go up to the mid cap 400. So it's like you lose all your winners. Like, it's like a AA team, AA baseball team, AAA. You're going to give up all your best players to the bigs. So it's never going to have sustained growth like that. The components of IWM that are leading right now are the small cap growth. And I was looking at that this morning, prepping for this and for everything else. The small cap growth is showing really good strength. And there's some AI related power generation names in there that are pushing IWM ahead that will graduate out of IWM and go up to the mid cap 400. So I can't get behind the small caps for a long period unless there's a total change. We have this onshoring, nearshoring, reshoring of, Trump's focus on U.S. businesses. If they were to drop interest rates, make funding widely available at competitive rates to small cap U.S. businesses, fine, that's a different conversation. But you can't compete with the large balance sheet mid and large cap tech companies that will go issue debt at the market at a really cheap rate. Small caps can't compete with rates that probably aren't going below 3.5%, 4.5%, 5%, whatever funding they get access to at their local banks. They can't compete. So I say for those two reasons, no, it's not sustainable.
Where are we at in the AI trade? I mean, I know you just mentioned a couple stocks there in the IWN, the power generation. Is it the pick and shovels? Is it Google? What's the state of the AI trade?
Yeah, I still think I think that Nvidia earnings was absolutely amazing. I mean, it's crazy how stagnant the stock is. I still think the backlog of Nvidia is amazing. I think with the Google chips out, TMUs, it's great. It's good. I think they're certainly giving OpenAI a run for the money. But in terms of competing against NVIDIA's advantage with the software CUDA on top of hardware, where they have their whole vertically integrated, I think they're still so far ahead. I just don't think, NVIDIA is getting enough credit for what they just put up on earnings. I mean, they beat on every metric. It was unbelievable. You've got a $4.5 trillion company growing at 50%. You're trading 30 something times forward earnings. Like it's bonkers. So I'm still very bullish on NVIDIA. Google is interesting. We're definitely seeing, as I said, a rotation into the offensive segment of utilities with power generation. So I think it's good. But, I think the biggest thing, it was such a soap opera, guys, to talk a little bit in rear view, like the whole Alex Karp, Michael Burry situation, his BS back and forth, writing these cryptic texts, saying he's bearish on AI, having the equivalent, if I had like $5,000 on Nvidia and Palantir puts 50% below the market, and like, oh, Inside Edge is short tech market. Like that was pocket change for him. The whole thing was such a distraction. It was so annoying going back and forth, and it kind of damaged the psychology in November. So we just got to get past that, I think, and then we can look into 26. So sorry to go backwards, but
no, that's fine.
I thought that was a significant event.
looking forward to 2026. I know you do your homework and you do your your weekly and monthly quarterly analysis. Do you have something in your back pocket? One stock for 2026 that you're keeping an eye on?
Oh man, one stock for 26.
That's a tough one. I
That's-
know. The acronyms, no sayings. Mine was horrible. Or one sector. I mean, I know you like to do things on an incremental basis, but
Yeah,
that's what the chat's at.
I'm going to say Palantir. I really do. I think, the valuation concern that people are talking about, this was like Nvidia back in 2023. Palantir has evolved from, I think it was like 60% of their revenues coming from government contracts. And if a company's too overly reliant on government, that's going to be a problem. But they're coming on so sharply in the private sector. The private sector numbers beat. I think Alex Karp just got some recently bad press in that interview he did. I hope he wasn't on drugs. He looked like it. But I think Palantir is shown a lot of relative strength. They're basically the AI. They're the software company of the AI build out. I think Palantir is going to be a really sneaky one. I still like Vistra on the power generation. I like CEG on power generation. I think some of the staples I think are acting well. Like look at Monster Beverage moving up. I think CELH, Celsius is kind of bottoming out into a good pattern. I'm going to look to add a little exposure to my short-term account. I think there's some staples. I think from a portfolio point of view, the way we do it is we find the 5 or 8 or 10 best stocks, the 11 sectors that have the best technicals and fundamentals for inclusion in the portfolio. So, we're looking for high growth, high fundamental, increasing earnings, increasing guidance with good technicals, but don't get too loaded in one sector. Have good diversification across the sectors, the 11 sectors, but only have the best 5 or 8 stocks that belong in your portfolio. That's what I would say.
What are you avoiding, Todd?
Yeah.
What are you avoiding? Anything you're avoiding?
In terms of sectors or stocks?
Both. If you want to go more sector wide or individual stock.
I mean, let me see. I can even show you. I can even go back to the portfolio if you like. Here, can I share screen again?
Yep, it's up there.
Okay, perfect. I'll even just show you the portfolios. I don't care.
Yeah, just real quick for our listeners here. Todd runs Inside Edge Capital. He's managing money, and I can attest he's doing a pretty good job at it. So if you had any questions for your longer term portfolios, just check out the Inside Edge website. Where'd Todd go? There he is.
I'm sorry. I closed the wrong window. My bad.
Okay. I was just telling people about your Inside Edge Capital and, taking into the portfolio management.
Yeah.
End, so, but anyways, put up that last thing for us and we'll let you skedaddle.
Okay. Sounds good. I'm up and let me just share. Sorry about that. I hit the wrong. What's this button do? Let me see here. Share screen. Window number. There we go. Perfect. All right. Sorry about that, guys.
That's okay.
Kind of reminds me of the time I kicked my microphone off live on air on CNBC. I was like, hang on one sec. I climbed under the desk and just got it, put it back on. And they're like shaking their head.
It happened to Dennis once too, and they never asked him back.
So I'm just showing you the adjustments we made here recently. Like this Netflix thing is really interesting with Warner Brothers. Like it's going to be so tied up in red tape with the FCC. On September 15th, we had 3% allocation in Netflix and growth. Last one, we went from 2% down to 1%. So I'm carrying 1%. I might have to kill Netflix here soon unless it starts to show some stabilization. Roblox, I'm looking to increase. The stock's come off sharply. I think it's hit. It's well positioned, the AI. And I know talking about to my kids and all their friends, they are back massively in Roblox. So I'm looking to kick Roblox up. I do like Mercado Libre. We increased from 1% to 2%. South American sort of Amazon equivalent MEI looks good. Tesla's on the highs. We did add Carvana. You look at the monthly chart in Carvana. I put that in November 20th, and that just got put in the S&P That thing is like the hedge fund rocket ship. We really increased Apple. We're at 3.5% in growth, and I kicked it up to 6.5%. I think the deal with Google and Gemini for AI with 1.5 billion phones installed user base is massive. Nvidia is fine. Broadcom. AppLovin looks amazing. That's sort of like the dating app for developers of apps and end users, businesses like ours, Joel. Palantir went to 3%. Credo, awesome. I added a 2% allocation and growth there. There's the industrials. Lemonade is a massive insurance disruptor. Ground up, all AI trying to disrupt a 100-year-old insurance industry. Watch Lemonade. Long way from profitability, but watch LMND. Robinhood's fine. I added some South American banks. The Argentine switch into a very libertarian, sort of centralization government has been huge. And there was wondering if there's going to be some others to follow in South America. I added 2 new positions in the materials end. As I mentioned, nothing consumer staples. I cut Costco and Hims from the portfolio. The GLP one is a mess. Costco has some real problems where Walmart is firing. Transmedics is awesome. TMDX, organ transplant, Garden Health, new one. I totally revamped healthcare. And I think if you saw on the sector rotation, healthcare is rotating out, but those are the large cap, lower beta value healthcare. These guys are sort of the growth, new age healthcare leaders. That's that. And then here's the utilities holdings: Vistra, Oklo, GE Vernova, and Talon Energy with a 2% Bitcoin. So I just took you through the whole growth portfolio.
Oh, fantastic. Todd, extended session here on PMP. I mentioned when you cut out there for a second, Inside Edge Capital, a growing asset management firm. If you're looking to do something with all that money you make in trading and day trading, and you want some active management, and I could attest, it's active. It's a very active management. Also looking for potential hedges in the market as well.
Thanks,
so,
Joel.
Todd, man,
can I say one thing on that real quick? Do you mind, or do you got to go?
Go.
The big thing, I think, you and I and all of us, we've been talking trading and traders for 20, 25 years. And I know you guys have a few on me, but not too many. The biggest thing when I launched Inside Edge, and I'm talking to all you active traders out there, is you've got to be able to bucket out. You got to compartmentalize and recognize what your active trading accounts do and what purpose they serve, what the duration is, and what your other money is, how it's allocated, what's the purpose. You've got to be planned. So when I launched an active management company, I found the best CFP I could, certified financial planner, because you've got to know and have your tax strategy laid out, have your risk numbers set, identify what you're trying to do in each account. Because I find a lot of retail traders mix everything up. They have a hard time being short or defensive in the short-term account, but long and strapped on and ready to go in the long-term account. Like, you've got to be able to bucket out your different accounts and have purposes and focus and risk parameters for each one. All of that should come together in a good financial plan. And only then, if you accepted the risk and you know what you're doing, can you let those accounts, hit the goals that you've laid out for them. So hopefully that makes sense.
No, that's perfect. Todd Gordon, he'll be joining us a lot here in 2026. Go to Inside Edge Capital and check out his method of money management. Thanks, Todd.
Thanks, guys, so much. Have a great rest of the week. Happy holidays, y'all.
Hey, Chris, how you doing?
Hey, fine. How are you doing?
Pretty good guess there, huh?
Yeah, he's great.
I saw you had something here in the screens. There's something you wanted to pop up to share here in the waiting minutes of the show?
Well, there are a number of things I'm looking at. I got to tell you, after the news in Nvidia, I'm actually looking at doing some spreads just under the market for this week because the vol is up. And you got to think good news, but it's already been discounted. And I have an idea of maybe playing something around 185, like a 10-point wide, like a put spread for this week. And not that I'm ravingly bearish whatsoever, but it just seems like all the good news is out. So I'm looking at something like that.
Set it up for us.
Sure. Now I'm not saying I'm gonna do it yet because right now it's too expensive. And so a lot of people ask, like, how do you know it's too expensive? And it's sort of like Sosnoff, and I traded next to him for a long time. I mean, in the same pit, in the same floor, and play golf with him and everything. I've never seen somebody that's so wrong on the market and make so much money because he's just an expert. And he'll be the first to tell you that. And his cohort, Tony, who I talk to all the time, always laughs about that. But the point is, you want to use premium to your advantage. And the way I'm looking at it in here, if you can see it, is when I talk about risk reward, if I'm going to do like a neutral spread, not like a put spread or a call spread, but a neutral, I'm not paying $4 with 3 days to go because I'm trying to go on the range of the stock today. So it got up to 191. So this spread would only be worth 4. And we've seen it at 179. That's only 4. So if it pops up today and I can get this like at 377, I'm interested. That just seems like a good risk reward, even with the Fed coming out. Because the problem is, I want some things that might do their own thing no matter what the Fed does. So I don't mind that idea around 377, something like that. Now, you might say, why don't you do next week? And that's a good point when things settle down. And then I do an even wider, like a 200, same thing. Under, let's say, $5, it would be great. It's probably 6. Yeah, it's 6. You just know that from experience of how high it is. That's one of those things like under $5, it would be great because that's been the range of the stock anyway. So I'm hoping the vol pops on the opening and I can do that like 5.5.
Okay, I like the setup there. I'm gonna add my charts to the stage here. Just do a couple earnings here before we wrap things up on this Tuesday. AutoZone misses $31 versus 32.37. And a miss, slight miss on sales here. No stock split. Losing the 50, losing the 200-day moving average. What sticks out to me on the monthlies? 3,500. That's still $180 away here, but a bearish formation here in AutoZone. Chris, any comments on AutoZone? You've been fixing your car lately, or you just buy a new car when the ashtrays are full?
Actually, it's we just totaled our minivan. So we're actually looking at another car, not total like a head-on, but my wife she says there was like a wall that shouldn't have been there.
Oh, the wall that shouldn't have been there trick. Okay.
And it was an older one, and so they just totaled it. So we're looking at cars. So AutoZone, I'm hoping we don't need it continuously for now, but I
Okay.
love AutoZone just as going to, especially remember when Home Depot went up a lot because people didn't want to buy a new house, so they wanted to fix up their house, like in COVID. And you wonder if the economy worsens, will AutoZone go up? Because people more likely to, there was just an article in Wall Street Journal about people balking at the high price of cars. So you wonder if people will just use AutoZone more.
Okay, Home Depot, not happy with the guidance that they gave. They reaffirmed 25. Not real happy about 26. You got the death cross on the 50 and the 200-day, traded down $8.50 and just hanging out near the lows of the pre-market session at 340. 340.08. Nope, 340 even marks that pre-market low. You got to be aware if it breaches 340, there's not much there. Not really a major cluster of lows until you get to the 332, 333 area. I'm not sure if this is affecting lows at all. Yep, lows trading down a couple sticks as well. On the other side of the guidance comes CVS, and CVS provides us some good guidance. We got a major level to look at. I know we're only a week into the month, but haven't reached last month's high at 81.72. You still got some heavy lifting to get up there. You ended last month at 80.36. You snuck over that level yesterday, but closed below it. So let's focus on the high of the move and see if we did. Yesterday's high is 81.06. So despite the guidance, not the move over yesterday's high as of yet, folks. Well, we're going to wrap things up here on this Tuesday. And this show is brought to you by Hive Digital Technologies, a global leader in green powered data centers for Bitcoin mining, high performance computing, and AI. Operating with nearly 0.5 gigawatt of renewable energy, Hive is on track to capture 3% of the world's Bitcoin production by the end of 2025. Scan the QR code on screen or visit the link in the description to learn more. Well, Chris Bretcher here. Some big shoes to fill with Triple D gone. We had Jim Tassoni yesterday. I thought he did an excellent job as well. Little bit of a change here, folks. Our pre-market listeners, our good friend Tony, right? Tony Pollock, the new owner of Real Life Trading. He's going to be taking over the show for the next 3 days, as I had a few days planned off before Dennis and Brent planned their getaways, but they're very deserving of a vacation too. So, hey, if you know any people a little bit newer to trading, there's going to be a lot of education here. They're going to be taking us over on the Stock Trader Network too. We'll still continue with some of our other programming here, but that's it, Chris. Chris, we're gonna stay on here and we're gonna hop over into the STN room and set some things up for this open. We started in the green and now we're in the red. So, folks, until Monday, be good. If you can't be good, be safe.